In this video, we're going to walk through the basic journal entries associated with the retirement or extinguishment of debt. Up until now, most of our journal entries associated with the retirement of debt have been when the company's debt has matured. And of course, at maturity, the premium or discount on any bond issue will have been fully amortized. That is, the carrying amount equals the face value of the bonds, and there's no gain or loss. We simply credit cash for the amount of the par value and debit bonds payable for the same amount. However, if a company extinguishes debt before maturity, there may be a gain or a loss. Let's take a look at some vocabulary. Any amount we pay to retire the debt before maturity, that will include any call premium or any other expenses, is referred to as the reacquisition price. One of the important things we need to remember if we extinguish debt early is we need to record amortization of any premiums or discounts clear up until the date that we reacquire the bonds. Just like plant, property, and equipment, if we dispose of a piece of machinery partway through the year, we want to record depreciation expense up and through the date where we dispose of or sell that equipment. Then we calculate any gain or loss. The same is true with the retirement of debt. We will amortize any premium or discount up until the reacquisition date. Then, when we reacquire the debt, if the reacquisition price is higher than our net carrying value, we will have a loss. So in other words, if the net carrying value of our bonds is $600,000 and we pay $700,000 to reacquire it, we've incurred a loss. On the other hand, if we only pay $500,000 to reacquire bonds that have a carrying value of $600,000, we will record a gain. Let's go ahead and take a look at an example. In this example, we're told that the Sunland Company issued 12% bonds some 9 or 10 years ago on June 30th, 2011. And the bonds had a par value of $770,000 and were due in 20 years. They were issued at a discount at a price of $98, and we can call them at a premium of $103, any date after June 30th, 2019. Now, because of lower interest rates and significant changes in our company's credit rating, we've decided to call the entire issue on June 30th, 2020, and to issue new bonds. The new bonds are going to be 10% bonds for $1 million, and they're going to be issued at 102. We're going to need to look at the journal entries associated with the original issue of the bonds, the retirement of the bonds, and then the issuing of new bonds in 2020. And we're told that the Sunland Company uses the effective interest method to account for the bonds. Again, the bonds were issued at 98, so we know the bonds were issued at a discount, and it's very simple to calculate that price. The price is $754,600. This is the face value of $770,000 times 0.98. We're also going to need to calculate the effective interest rate, since we're told the Sunland Company uses the effective interest method to account for our bonds. We can use Excel's rate function to calculate this. In using the rate function, we're going to want to enter in 40 for the number of periods. For the payment, we're going to want to take that face value of $770,000, multiply it by 12%. That will give us the annual payment. Then, of course, we'll divide that by 2 because it's a semi-annual coupon. The initial present value would have been the $770,000 times 0.98, or the $754,600. And then the future value of the bonds, or the face value, is $770,000. I've entered these as numbers here so you can see more clearly the calculation. Be sure to use Excel references. Now, when I hit enter, notice it returns an interest rate of 6.14%. And again, we've done semi-annual compounding. We put in 40 for the number of periods. These are 6-month periods, so this 6.14% is a 6-month interest rate. We need to take that interest rate and multiply it by 2 to get the annual interest rate. And notice this interest rate is higher than the bond stated interest rate, which again is why this bond sold at a discount. Remember, the 98 at an issue price of $7.54. In any event, we need to record the issue of this bond. We received $754,600 in cash. We always record bonds at their face value, and we will make debits equal credits by recording a discount in bonds payable in the amount of $15,400. Before we can prepare the journal entries for the retirement of the bonds, we need to prepare our bond discount amortization table. And again, this is our effective interest method. First thing we wanted to do again was to pick up the net carrying value of the bonds when they're issued. Then, of course, every time we make a coupon payment, we're picking up that coupon payment. And again, that was the face value of the bonds. And you're going to want to enter that using an Excel formula with cell references with anchors so you can copy it down. The links, though, would be to the $770,000 face value times the 12% stated interest rate divided by 2 because it's a semi-annual coupon. The interest expense, then recall, is the 12.28% market interest rate divided by 2 because it's a semi-annual coupon bond multiplied by the bond's current carrying value. The difference between the cash paid and the interest expense is our amortized bond discount. And over time, recall, these bonds were sold at a discount and their net carrying value will increase over time. At the end of the first 6 months, the carrying value will be $754,696. If you've used proper anchoring, you'll be able to copy that row all the way down your amortization table and get the entries and balances we need as of June 30, 2020, when we retire the bonds. On June 30th, before we can record the entry for the retirement of the bonds, we need to record our final coupon payment, interest expense, and amortization. Our cash payment, our coupon payment, is the $46,200. We need to record interest expense of $46,465, and of course, the amortization of our bond discount in the amount of $265. We were told that the bonds were retired or redeemed on June 30th at a price of $103. We will record a credit to cash in the amount of $793,100. This is the $770,000 face value times 1.03 or 103%. We need to take the bonds payable off our books, so we'll debit bonds payable for $770, and we need to take the remaining discount off our books, and that remaining discount will be $12,389, and that's simply the difference between our carrying value at that point in time, the bond's face value at that point in time, or par value, minus the carrying value. There's the $12,389. At this point, debits don't equal credits, and we're going to need to record a loss on retirement. And this loss is the plug that makes our journal entry work, or it's simply the difference between the cash that we paid to retire the bonds, less the bond's net carrying value. We're told that we issue the new bonds at a price of 102, or 102% of par. The bonds had a par value of $1 million, so our issue price will be $1,020,000. Of course, we always record our bonds payable at their par value or face value of $1 million. Debits don't equal credits, so we will need to credit a premium on bonds payable for $20,000.